Everyone wants to save money when they buy a home. They negotiate with the seller for the best deal and then look for a mortgage with the best rate. So when they buy the home, they know they've saved as much as possible. That makes sense, right? If you're like most people, you probably think so too. And you'd be wrong. In fact, they're not even close, but only what most people are taught. You're about to learn how people in other countries save hundreds of thousands of dollars when they buy a home. And so can you. Our financial system gives banks a clear advantage over depositors. First, they offer checking accounts that pay little or no interest, and savings accounts that offer such low returns that hardly anyone uses them. When these institutions make mortgage loans, they charge us about 7%. Lenders also know that most people stay in the same house for only 5 to 7 years, so they've structured our loans so that most of the payments go for interest, and very little towards principal until the final years. When we purchase our next house, they start the process all over again, so hardly anyone pays off their loan. Consider how we've been taught to manage our finances. We all have a checking account. When we purchase a home, we also have a mortgage account. We deposit our income into our checking account. From checking, we make our regular mortgage payment, and then pay our other monthly expenses by check or using a credit card. Unfortunately, this system also guarantees we'll be in debt for a very long time. In a typical 30-year mortgage, we hardly pay off any of the principal in the early years because most of the payments go toward interest, so the balance of the loan remains high. For example, in a 30-year, $300,000 loan at 6.75%, we can see how little the loan is reduced each year. In fact, after 6 years, we still owe $277,000. Using that same example, after 6 years, we would pay over $140,000, almost half of the amount we borrowed. But we would only have reduced our loan by $23,000. The interest rate is only 6.75%, but after 6 years, we would still owe $277,000. There's a secret that lenders don't talk about, and it's that mortgage interest is calculated on the daily principal balance of the loan. That means that if the daily loan balance is reduced, the amount of interest is also reduced. So when the homeowner sends in their monthly payment, less of that payment goes to the interest portion, and more towards the principal portion, reducing the balance further. The key banking principle is why mortgage magic works so effectively. Using the key banking principle, an ingenious system was developed that reduces the loan balance by using the homeowner's income to offset the loan. In Australia, New Zealand, Singapore, Malaysia, South Africa, the UK, Canada, and now in the United States, people are learning about it and using it to cut years and hundreds of thousands of dollars off their mortgage costs. So you see how the banking system is designed to place you at a disadvantage when paying a mortgage. When we see things as they really are, we can also understand that there is a way that gives the advantage to borrowers and not to lenders. Mortgage magic is a very simple technique that uses the key banking principle to make the system work for you instead of against you. Remember that we have separate checking and mortgage accounts? The mortgage magic system effectively combines these two accounts into one, having the characteristics of both. We call it the mortgage checking account. Using the mortgage checking account is exactly the same as using separate accounts. Remember the key banking principle that interest is calculated on the balance of the loan. When money is deposited into the mortgage checking account, the loan balance is reduced. As funds are withdrawn to pay bills, the account balance rises. The overall effect is to reduce the amount of calculated interest in two ways. First, by reducing the average daily balance during the month, and second, by any surplus funds remaining in the account at the end of the month. Look at the difference after just 1 year. By paying the conventional way, the balance of a $300,000 loan at 6.75% is $297,000. Using the mortgage checking account, the balance is $286,000. We've made the same monthly payments for both, $1,945.79. Do you know how long it would take to pay off $14,000 the conventional way? You would have to make 4 years of payments to reduce your balance to this level, and you would have to pay $78,000 of interest to get there. Here's the full comparison of using the Mortgage Magic system to pay off a $300,000 loan at 6.75%. Using this system, our loan is completely repaid in 12 years, 7 months, cutting 17.5 years. And remember, this was achieved making the same monthly mortgage payments. Notice that when our loan is repaid using Mortgage Magic, we would still owe $240,000 paying the conventional way. We've saved $238,000 in interest using Mortgage Magic with typical family income and expense ratios, and cut 17.5 years off the loan without making a single extra mortgage payment. And without the debt burden of your mortgage, you can continue to make payments into your savings account to secure your retirement. Over the next 17 years, your savings will grow to over $750,000 using the same money you would have paid in interest. In some countries like Australia, the financial institutions offer mortgage checking as a single account, combining checking and mortgage services. However, in the U.S., lenders are not interested in providing a financial product that would take away their traditional advantages. Fortunately, you can get the same results by setting up a HELOC or home equity line of credit to link your checking and mortgage accounts. It's really that simple, and after setting it up, the online software provides a roadmap to your financial future. The software takes into account your own income and expenses, showing you when you can expect to be debt-free. As your finances change, the software continues to provide guidance and is the key to risk-free wealth. Use it for new mortgages and existing mortgages. You don't need your lender's consent because it doesn't change your mortgage, just the way you pay it. To get started quickly, get the Quick Start Support Package. It provides phone support for 3 months after your purchase with an expert who can answer your questions and show you how to make the system work automatically, just like the packaged product in other countries. Buy Mortgage Magic risk-free with our money-back guarantee if you're not completely satisfied. And remember, it's not rocket science. It's really simple real estate.